All right, welcome back to the Double Play channel, where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy to invest in real estate. If you've been scouring the internet looking for information on how to use a life insurance policy for investing in real estate, you've come to the right place. So I would recommend bookmarking this page and subscribing to this channel right now, because you'll want to do a deep dive onto all of the other content that I've got on this video, assuming that you just found this video. But if you've made your way here, in today's video, I want to stray a little bit from the double play concept to talk about what I think of as one of the more fundamental concepts in life insurance, which is the concept of tax-free retirement income from a life insurance policy. And I want to address this for two reasons. One is, it is a core fundamental that needs to be revisited every once in a while. And two, just a few days ago, I saw that the U.S. total debt had surpassed $30 trillion. And nothing makes a stronger case for having a source of tax-free income than the government being at that obscene of a level of debt. Because how do you think they're going to recover that someday? They're going to be increasing taxes at some point in the future to try and reduce that debt. Or they're going to inflate their way out of it, which kind of looks likely too. So, in any case, if you are interested in learning how you can get tax-free income from a life insurance policy, then stick around after the intro and I will break it all down for you. All right, thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies. I created the Double Play channel basically to answer the questions that you have, how to invest in real estate using life insurance. I've been doing this for a long time, and I know the questions that typically come up that people have, and all of the videos in these series of videos and the information that you'll find on my website and blog posts and recorded webinars is basically there to answer the questions that you have and to give you the information that you need to put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. So along the way, we're going to debunk all the myths and misconceptions of life insurance, and I'm going to give you the tools that you need to learn everything that you need short of seeing an actual illustration. So you shouldn't need to talk to an agent or give me a call until you're ready to pull the trigger and you want to see what an illustration looks like for yourself. So with that, today we're going to be talking about life insurance retirement plans. The main point that I want to make in today's presentation is that life insurance stands on its own merits. I mean, the double play is great. You can put your money to work in two places at one time. You can leverage basically your retirement savings while you're waiting to retire. I mean, you can't do that with an IRA or 401k. So even if you never leverage the cash value, you're going to get more bang for your buck from leveraging the cash value of a life insurance policy to generate tax-free income than you would in almost any other source of or retirement asset, source of retirement income. All right, so I made a pretty bold statement that you can get 2 to 3 times the income from the same amount of money. So what I want to do is I want to give you an example of what that looks like with some practical numbers. I want to explain how this is possible, how life insurance can generate so much more income than traditional investments. Then we're going to dive in and take a look at an actual life insurance illustration so that you can kind of see how the numbers move and all the moving parts. And then I'm going to show you how you can use that illustration to do some just some basic retirement planning, income planning. So before we get started, let me take care of a couple of housekeeping items. Just keep in mind that the purpose of life insurance is for the death benefit protection. Any other benefit is purely ancillary. Also, all of this information in this video is purely educational. There is no tax advice, no financial advice, and no legal advice being offered. So, All right, so 2 to 3 times the income. That's a pretty bold statement. And for starters, it's like, 2 to 3 times what? What are we talking about here? Financial advisors use what's called the 4% rule to determine the safe withdrawal rate from your retirement savings to ensure that you can maximize income but not run out of money while you're still alive. So what this means is if you have $1 million in a hypothetical 401k, for example, that you could safely take $40,000 a year in distributions and not risk running out of money before you pass away. Well, $40,000 a year of distributions from an IRA, those distributions are taxed as ordinary income because you got a tax deduction or it was withheld from your income when you put the money in. So if you're just in a 25% tax bracket, for example, 25% of 40,000 is 10,000. So your net after-tax income on $40,000 distribution from your $1 million 401k is only $30,000. So it's a little discouraging to think that you can only get $30,000 of income from $1 million of savings. But it gets even worse. I mean, that's a 25% tax bracket. What if you're in a 40% tax bracket? Then that after-tax income looks more like $24,000. So what is the equivalent amount that you could get from $1 million of cash value? Well, in a life insurance policy, 8% seems to be the equivalent rate of safe withdrawal from a life insurance policy. And I'm a little bit more conservative than that when I do my projections. But if you can earn at least 1 percentage point of arbitrage, meaning the difference in the rates between the rate that you're paying on loans that you're taking from the policy. Remember, retirement income from a life insurance policy is in the form of loans. That's why it's tax-free. So you're taking policy loans from the insurance company secured by the cash value of the policy. The cash value is also growing because it's not leaving the policy. So as long as there's 1 percentage point of arbitrage between the rate that you're paying and the rate that you're earning, you should be able to take at least an 8% level income from the point that you retire, based on the amount of cash value that you have the year before you retire. So in our example, if you have a policy with $1 million of cash value at the time you retire, that's $80,000 a year of tax-free income. Now, you don't need a calculator to figure out that 80,000 compared to 24,000 or 80,000 compared to 30,000 is almost 3 to 1. So that's the 2 to 3 times the income from the same amount of money that I'm talking about. So now your head is probably spinning, wondering, well, how is this possible? So that's what I want to cover next. The reason that life insurance is so powerful is that you are borrowing from the insurance company and taking loans to finance your retirement. So I know this is counterintuitive, that it doesn't make sense that you could borrow your way into more income. But you need to understand that when you're taking income, your cash value is serving as collateral. The cash value is never leaving the life insurance policy. So in our 401k example, $1 million minus the $40,000 distribution leaves you with $960,000. And that $960,000 is going to earn interest and dividends or capital gains. Whereas our $1 million remains $1 million even after we take an $80,000 loan. And after 5.5% interest is credited, you've got $1,055,000 of cash value. So the cash value is growing and compounding with every passing year, compared to the 401k, which is getting whittled down. I mean, it's still growing, but it's getting whittled down, and you're not able to replace everything that you're taking out. So that is the power of a life insurance retirement plan. It's being able to leverage that cash value. And the easiest way that I can really explain this to you, or have you see it for yourself, is to just go out and build a spreadsheet. Take a sum of money and project it forward over time at some reasonable rate of interest, like 5.5%, 6%. That's your cash value growth over time. And now have another column of numbers. Look at what you could take in loans, and then assume that you're also financing the interest. So you're not making any interest payments on the loans. You're borrowing the interest from the insurance company. So let's talk about life insurance loans for just a second so that you understand what's going on. All 50 states in the country, insurance is regulated at the state level, have language in their insurance statutes that basically requires that all insurance companies must make loans to their policy owners secured by the cash value of those policies. So it doesn't say that you're taking your own money or you're able to borrow your own money. It says that the insurance company must make loans to you secured by the cash value in your policy. And even better, the language goes on to state that if the policy owner fails to make an interest payment on the loan, the insurance company is to basically advance the policy owner the money to pay themselves the interest, and then they can tack it onto your loan balance. Now, if that ultimately leads into policy lapsing, that's a problem. But when you're doing it on purpose, and in here, just keep in mind, if there's a positive interest rate arbitrage, which is entirely possible, the loan balance will grow at a lower rate than the cash value that's securing it. You'll ask, is that possible? Well, just in today's world, with cap rates as low as they are today, the expected annualized return of a life insurance policy is still about 5.5%. Meaning, if I take today's low cap rates and I apply them to the changes in, say, the S&P 500 index over the last 30 years, I would still end up with a 5.5% return. Now, that's very unlikely that cap rates would remain at this level going into the future if interest rates were to rise. But that's where we are today. 5.5% is what you should reasonably expect your IUL to perform if cap rates stayed as low as they are right now. But interest rates are also very low right now. So you can borrow money from a bank at prime, which is about 3.25%. And you can borrow from the insurance company at between 3 and 3.25%. Different companies have different rates, but the companies that I'm working with, typically you're looking at 3 to 3.25%. So 3.25% to 5.5%, that's a 2+% arbitrage between the rate that you're paying on your loan and the potential rate that your cash value is earning. So that's a 2% arbitrage. All you need for the 8% rule to hold is just a 1% arbitrage. And generally, when I run my illustrations, they're even more conservative than that. All right, it might be easier to get your arms around this if we look at an actual life insurance illustration. So I prepared these numbers based on a hypothetical 45-year-old non-tobacco using healthy, so I gave him a preferred non-tobacco rating. This 45-year-old is putting premium of $25,000 a year into a policy until he's age 65, basically 21 years. And then we're letting the computers or the application's software solve for the maximum income that they can take from age of retirement. So if we look at this illustration right around ages 65 and 66, you can see that the cash value at the end of age 65, after the interest is credited, is $904,591. And hopefully you've already gotten your calculator out and you've divided the $62,613 by that income to see if Tom was right about the 8% rule. If you did that already, you found that the income ratio is about 6.92, so it's just shy of 7%. But as I stated, I like to be a little bit more conservative when I'm showing something to a client. I want them to understand what the potential is and understand that I'm making these inputs very conservative and tough to actually meet. So let me just explain what I've done here. The loan interest rate that I'm assuming in this example is 5%. And as I stated earlier, you can actually borrow today at 3.25%. With this particular policy, they've got an indexed loan option, which is available on a lot of policy nowadays, which keeps the interest rate at 5% regardless of what changes in the future, of interest rate changes in the future. So it's kind of a worst case scenario knowing that the interest rate will never get over 5, so we're just using 5. But also, since interest rates are as low as they are right now, I'm still only assuming that the policy is growing at 5.5% growth going forward. So those two things are unlikely to be true at the same time. I mean, if interest rates get to the point where the borrowing rate is at 5%, then the cap rates would have gone up too because interest rates went up. So right now we have about a 0.5 percentage point of arbitrage, and you can see that even at that, the policy is still capable of generating income at a rate of almost 7%. Now, I could scroll down and show you that this illustration runs all the way out through age 120, and that the $62,000 a year runs all the way out through age 120 as well. So I mean, this client will never outlive that income. It's not just for 20 years, it's not just for 30 years, it's the max that that person can take without running out of collateral before they pass away. Now, let's take a look at some fundamentals that some things that I want you to take away from this. All right, the first thing I want you to look at is notice the cash value column. And at retirement age of 65, there's $904,591 there. The following year you're going to take the policy owner is going to take a loan for $62,616 for income. And if you look just to the right of that, you'll see that the cash value actually increased from $904,000 to $955,000. If you keep looking down that column, you'll notice that it grows the next year to $1,009,000, then $1,065,000. So it's clear that you're not physically taking any money out of the policy. That should be obvious, that the cash value is continually growing to secure the growing and compounding loan balance that's occurring because you're borrowing $62,613 every year. Not only that, but at the end of the year when you owe interest on that $62,616, you're borrowing that from the insurance company and tacking it onto the loan balance. So over time, your loan balance is growing, is compounding, and getting bigger and bigger and bigger. But just understand that the cash value is growing and getting bigger and bigger and bigger too. So the important takeaway is when you're doing your retirement planning, that you not dip too deeply into the collateral. And we are dipping into the collateral because if the policy is growing at 5.5%, clearly you can't take 7 without tapping into the collateral a little bit each time. So the important thing is just to make sure that we don't run out of collateral. Now this is expressed in the surrender value column. So for years 1 through 21, you can see that the surrender value is exactly the same as the cash value until year 22 when you take that first loan for income. Now the cash value is $955,000, but the surrender value is $891,000. So what happens if you were to surrender the policy? Well, you really have $955,000 of cash value in your account. But if you try to surrender the policy, the insurance company is going to take $62,000 plus the interest to pay off that loan, and they're going to give you the rest. Just like when you sell a house with a loan outstanding on it. You're not even going to see the sales price. That loan is going to get settled right at the closing table. Now, the next thing that I want you to pay attention to on here is the death benefit. So in a maximum overfunded life insurance policy, one of the key facets of that is keeping the death benefit to an absolute minimum at all times so that the load on the cash value is minimized, because it's the death benefit that is the load on the policy. So at age 65, you can see a $200,000, almost $13,000 decrease in the death benefit that is not explained by the $62,000 loan. So two things are going on in that number, in that decrease from 1.28 million to 1,072,000. The first is we're making a face reduction on the policy to drive some cost out, and we can do that because we're no longer putting any premium in the policy. That premium, as long as you want to pay $25,000, you need that higher death benefit in order to slip that much cash into the policy without creating or violating the definition of life insurance. Creating a MEC or violating the definition of life insurance. So the other thing that's going on too is all life insurance illustrations, and I frankly think this is a flaw, they express the death benefit as net of any loans. So you'll often hear people state that policy loans reduce the death benefit. That is not true. The death benefit is something higher, is always going to be higher than the cash value. I mean, it's just impossible if you understand that the cash value is literally the policy owner saving up the death benefit for the insured over the insured's lifetime, it's impossible for the death benefit to be lower than the cash value. But the death benefit is showing the net after any loans are paid off. So the true death benefit is higher, but once the $62,000 loan is paid off, there's $1,072,000 left. So hopefully that's clear. I kind of rambled there for a second, but so from age 66, looking at the surrender value column and the death benefit column, as you go down those columns, you can see that the surrender value and the death benefit column are both reducing. And again, it's showing you the net of any policy loans, and the surrender value is going down because the rising loan balance is being offset against the cash value, and the surrender value shows you how much cash value is still there and can still be leveraged. Like if we take a look at age 75, for example, right here, we've got $1,564,306 of cash value. Surrender value is $755,596. You could take a $755,000 loan right there if you wanted to. You've got that much collateral that you can borrow against. So if you've got something that you can do with that money, whether it's an investment or something else, you still have access to that. But if you took that, just understand that the net death benefit and the surrender value would be reflected the next time around. All right, so the last thing I promised I would do is just talk a little bit about retirement income planning using a life insurance illustration. So this is nothing too fancy. It's not rocket science, but a life insurance illustration shows that if, like in this case here, we put in $25,000 a year for 21 years, this person should be able to borrow $62,000 a year for the rest of his life. Well, is $62,000 a year enough for this person? We don't know what he was making, is making, what he intends to, what that $62,000 is going to be worth 21 years in the future due to inflation. So all of those things kind of need to go into your mind first. Think about what your retirement lifestyle is going to be like, where you're going to be living, what the tax rates are you going to have to pay rent, how much money do you need to live on? And think about how much potential inflation there's going to be between now and then. So try to get a number in mind of what you need to retire, and then just compare it to this number. If after doing all that, is $62,000 enough? If it's too little, now you've got to think seriously about whether you can afford to put more premium in every month, or maybe that $25,000 represents the most you can put in today, but your income is not going to be static. I mean, at some point in the future, it's going to rise and you will be able to afford more. So, you can modify the policy at that time to increase the death benefit to allow for more premium to go into the policy, or you can open up a second policy. The death benefits over time too tend to be deflated with inflation. What may have seemed like a lot of death benefit 20 years ago may not cut the mustard today. So what I want you to understand and take away here is everything in life insurance is scalable. So if you double the premium, you will double the cash values, and you will double the death benefit, and you will double the income projections. So using our example here, I mean, if this person put in $50,000 a year of premium, he could expect there to be about $125,000 of cash value, or not cash value, income starting at age 66. His cash value at retirement age would be more like 1.8 million, and the death benefit would be double what you see here. So we can easily back into how much it would be necessary to meet your goals, and plan accordingly. Now, the only thing is if you know that you can put in more later, just keep in mind the power of compounding interest. You can't simply just increase the premium. Let's just say $50,000 a year was where this guy needed to be, but for the first 10 years he couldn't afford to put in 50. So he can't, after 10 years, go to 50 and think he's going to make up for the 10 years where he shorted it by $25,000. So he missed out on all that principal going in, as well as all the compounding interest on that over that time. So you can't simply make it up at 10 years in the future. So you gotta start over again and do some planning to account for, again, how much money you're going to need to put away to reach that target from a vantage point of 10 years in the future. So, all right, just to wrap things up, I have shown you how a life insurance policy can generate 2 to 3 times the after-tax income of almost anything else that you can put your money into for retirement planning purposes. Now, not real estate, of course, but I'm talking about traditional retirement planning assets. And I've also shown you how you can use a life insurance illustration to do some basic financial or tax-free income planning. So, and again, I just want to, say that life insurance, especially a life insurance retirement plan, life insurance stands on its own merits. Even if you don't do anything sophisticated like the double play where you're leveraging the cash value to put your money to work in 2 places at one time, you're still going to get more bang for the buck by putting your money into a life insurance policy and leveraging the cash value for retirement income than almost anything else you can put your money into. I run these numbers every single week for people. And very seldom, and maybe a 25-year-old fresh out of college, modeling, 10% growth stocks year over year, maybe that would grow to be enough accumulation that 4% would outweigh that 8% that you can get from a lower growth life insurance policy. But it's very unlikely. It very seldom happens when I'm doing a side-by-side comparison. Because this is part of like every presentation I do. I do a side-by-side comparison of what your retirement income would look like if you funded the policy at this level versus funding some other investment growing at X% rate at the same exact level. And it just always provides more income. So you will get more bang for your buck from a life insurance policy than you will from almost any other asset. So with that, I am done. I appreciate you tuning in. Be sure to subscribe to this channel. Give me a thumbs up if you enjoyed the content, and I will see you in the next video.